Hi, we'll go through the various sections regarding income from house property. Section 22, charging section. Section 23, annual value computation. Section 24, deductions. Section 25, interest payable outside India. Section 25A, arrears of rent and unrealized rent. Section 26, co-ownership. Section 27, deemed owner. Nature of property and the net result of computation. In the case of let out property and deemed let out property, the net result can be any amount of income or loss. In the case of self-occupied or an unoccupied property, it can be either nil or loss subject to a maximum of rupees 2 lakhs. In the case of property held as stock in trade, it can be either nil or loss. Let out property, computation format. Gross annual value less property taxes paid to the local authority, we get net annual value. We subtract the deductions under section 24. Number 1, 30% of the net annual value, and number 2, interest on loans paid or payable, we get the income from house property. For municipal taxes it is paid, for interest on loans it is paid or payable. How to compute gross annual value? Step 1. Compare fair rent with municipal value, whichever is higher, that is the fair rent. Step 2. Compare the fair rent as arrived in step 1 with the standard rent, whichever is lower, that's the fair rent. Step 3. Compare the fair rent determined in step 2 with the actual rent. Now, if the actual rent is greater than fair rent, then actual rent is the gross annual value. If the actual rent is lower than fair rent on account of vacancy, then actual rent is the gross annual value. If actual rent is less than fair rent on account of other reasons, then fair rent is the gross annual value. Fair rent is nothing but a rent which a similar property would fetch in the same or similar locality. Actual rent will not include unrealized rent if the conditions of Rule 4 are satisfied, and standard rent is applicable only in select cities, right? So step 2 will be applicable only if the property is in select cities like Delhi. Actual rent not to include unrealized rent. What are the conditions under Rule 4? Number 1, tenancy must be bona fide. Number 2, defaulting tenant has vacated or steps have been taken to compel him to vacate the property. Number 3, defaulting tenant is not in occupation of any other property of the assessee. Number 4, assessee has taken all reasonable steps to institute legal proceedings for the recovery of the unpaid rent or satisfies the assessing officer that the legal proceedings would be useless. Municipal taxes. It should be borne by the assessee. It should be actually paid during the previous year. If the municipal taxes of 1 year are paid in arrears in the subsequent year, then deduction can be claimed in the year in which the actual payment is being made. In the case of property situated outside India, taxes levied by the local authority of the country in which the property is situated is deductible. It can be claimed as a deduction only in respect of let out property or the deemed to be let out property. Deductions under section 24. There are two deductions. Number 1, 30% of the net annual value. It is a flat deduction, and deduction is available even if no expenditure is incurred by the assessee. The second one is interest on loans. So interest on loans borrowed for the purpose of acquisition, construction, renovation, repair, reconstruction can be claimed as a deduction. Interest relating to the year of completion of construction can be fully claimed in that year irrespective of the date of completion of the construction. Interest payable during the construction period preceding the year of completion of construction can be accumulated and claimed as a deduction over a period of 5 years in equal installments commencing from the year of completion of construction. That is, pre-construction interest can be claimed in 5 equal installments commencing from the year of completion of construction. Special situations where a buyer enters into an arrangement with the seller to pay the sale price in installments along with interest due thereon, the seller becomes the lender in relation to the unpaid purchase price and the buyer becomes the borrower. In such a case, unpaid purchase price can be treated as the capital borrowed for the acquiring the property, and interest paid thereon can be allowed as a deduction under section 24. Interest payable in respect of the second loan taken to repay the original loan would also be admissible as a deduction in the computation of income from house property. Interest on loan can be claimed on an accrual basis. It is paid or payable. Interest on unpaid interest or principal cannot be claimed as deduction because it is in the nature of a penalty. Brokerage or commission paid for acquiring a loan will not be allowed as a deduction. Interest on loan which is borrowed and which is payable outside India shall be allowed as deduction only if tax is deducted and remitted to the account of the government. Self-occupied property and an unoccupied property. What is the computation format? Gross annual value is always nil. Less interest on loans paid or payable, and you end up with a loss from house property. Now, the benefit of the nil annual value is available only for up to 2 self-occupied or unoccupied house properties, that is, for either one house property or 2 house properties, and no deduction for municipal taxes is allowed in respect of such property or properties. Regarding the interest on loan, what is the amount which is deductible? Situation A, if the loan is borrowed before 1/4/1999 and where the property has been acquired, constructed, repaired, renewed or reconstructed with the borrowed capital before 1/4/99, then the actual interest payable in aggregate for one or two self-occupied properties subject to a maximum of rupees 30,000. So 30,000 is the maximum interest which can be claimed as a deduction. And most important, the loan must be borrowed before 1/4/99 and the property has to be acquired or constructed, repaired, renewed or reconstructed before 1/4/99. Situation B, if the loan is borrowed on or after 1/4/99 and where the property is acquired or constructed with the loan borrowed on or after 1/4/1999 and such acquisition or construction of the property is completed within 5 years from the end of the financial year in which the loan was borrowed, then the actual interest payable in aggregate for one or two self-occupied properties subject to a maximum of 2 lakhs. So 2 lakhs is the maximum deduction which can be claimed, and we need to produce a certificate which certifies or which specifies the amount of the interest payable that has to be furnished by the assessee. The most important point is loan must be borrowed on or after 1/4/99 and look at the purpose of the property. The property is acquired or constructed. There is no mention about repair, renewal or reconstruction. That is important. If the loan is borrowed on or after 1/4/1999 and when the loan is borrowed for carrying out repairs, renovation or reconstruction of the property on or after 1/4/1999, the actual interest payable in aggregate for one or two self-occupied properties subject to a maximum of rupees 30,000. So 30,000 becomes your maximum amount which is deductible. Now the most important point is, however, the total interest deduction under A plus B cannot exceed 2 lakhs. So we had two situations, situation A and situation B. right? So cumulatively, right, it is only 2 lakhs. The maximum interest which can be deducted is only 2 lakhs. What is an unoccupied property? Where the property consists of a house or a part of a house which cannot actually be occupied by the owner by reason of the fact that owing to his employment, business or profession carried on at any other place, he has to reside at that other place in a building not belonging to him. What is a deemed let-out property? If the assessee owns more than 2 properties falling under the categories of self-occupied property and unoccupied property, then the income from any 2 properties at the option of the assessee shall be computed as self-occupied and their annual value will be nil. The other self-occupied property or the unoccupied properties shall be treated as deemed to be let out properties. This option can be changed year after year in a manner beneficial to the assessee. So what is the computation format? Gross annual value is XXX. From that you subtract the property taxes or the municipal taxes paid to the local authority. We get the net annual value. From that, if you reduce the deductions under section 24, which is 30% of NAV, and then interest on loans paid or payable, we have the income from the house property. Now, how do we compute the gross annual value in the case of a deemed let-out property? Step 1. Compare the fair rent with the municipal value, whichever is higher, that is the fair rent. Step 2. Compare the fair rent as arrived in step 1 with the standard rent, and whichever is lower, that is the fair rent. The concept of actual rent does not arise in a deemed let-out property. What is income from property held as stock in trade? Where the property consisting of any building or land appurtenant thereto is held as stock in trade, and the property or any part of the property is not let during the whole or any part of the previous year, the annual value of such property or part of the property for the period up to 2 years from the end of the financial year in which the certificate of completion of construction of the property is obtained from the competent authority shall be taken to be nil. So it's a 2 years period from the end of the financial year in which the CC, it's called certificate of completion of construction, is obtained. So I have given an example. Look at this. If the CC is obtained on 18/11/2019, the benefit under section 23(5), what is the benefit? You can take the annual value to be nil, right? So it shall apply for the financial year 1920, that is assessment year 2021, and then 2 years, assessment year 21-22 and assessment year 22-23. Deductions. Section 25. Interest chargeable under this act which is payable outside India shall not be deducted if tax has not been paid or deducted from such interest, and in respect of which there is no person in India who may be treated as an agent. So it talks about interest payable outside India. We need to deduct the tax and remit it to the government. What about the taxability of the arrears of rent and unrealized rent received later? The amount of arrears of rent received from a tenant or the unrealized rent realized subsequently from a tenant, as the case may be, by an assessee shall be deemed to be the income from house property in respect of the financial year in which such rent is received or realized. The same shall be included in the total income of the assessee under the head income from house property, whether the assessee is the owner of the property or not in that financial year. So ownership is not a question. What is the deduction? A sum equal to 30% of the arrears of rent or the unrealized rent shall be allowed as deduction, which means flat 70% will be taxable. Co-ownership, section 26. If two or more persons jointly own a property and if their shares are definite and ascertainable, then the income from such a property shall be assessable individually in respect of the lease rent and not as an AOP, association of persons. The share of income of each such co-owner should be determined and included in his individual assessment. However, where the house property owned by the co-owners is self-occupied by each of the co-owners, the annual value of the property will be nil, and each co-owner shall be entitled to a deduction of 30,000 or 2 lakhs as the case may be under section 24 clause B on account of interest on the borrowed capital. However, if the co-owner owns another self-occupied or unoccupied property, the aggregate interest from the co-owned property and the other self-occupied or unoccupied property cannot exceed 30,000 or 2 lakhs as the case may be. Where the house property owned by the co-owners is let out, the income from such property shall be computed as if the property is owned by one owner, and thereafter such income so computed shall be apportioned amongst each co-owner as per their specific share. If the share of each co-owner is not definite and if it is not ascertainable, then the income from the house property will be determined and charged to tax in the capacity of an association of persons. Deemed owner, section 27. Transfer of a house property to spouse for inadequate consideration. In that case, the transferor will be deemed to be the owner. However, there is an exception. If the transfer is in relation to an agreement to live apart, then the transferee, the spouse, will be considered to be the owner. Second one, transfer to a minor child. Then the transferor will be deemed to be the owner. However, if the transfer is made to a minor married daughter, the minor married daughter is considered the owner and the transferor is not deemed to be the owner. Holder of an impartible estate, member of a cooperative society, a person in possession of a property under section 53A of the Transfer of Property Act, and any person having a right in a property for a period not less than 12 years, they are considered to be deemed owners. Composite rent. If the let out of the building and other assets are separable, then the rent received in respect of the building which is let out will be chargeable under the head income from house property, in short IFHP. The rent received in respect of providing other assets or rendering of services will be charged either under profits and gains of business or profession, short PGBP, or income from other sources, in short IFOS. On the other hand, if the let out of the building and other assets are inseparable, then the composite rent will be chargeable either under PGBP or IFOS as the case may be. Let's take a special situation where a property is let out for a period and self-occupied for a period. Now, if that be the case, let's take 9 months it is let out, 3 months it is self-occupied, then it shall be treated as a let out property under 23(1). In such cases, the fair rent of the property for the whole year shall be compared with the actual rent, and whichever is higher shall be adopted as the annual value. Actual rent shall be the rent received or receivable for the let out period during the previous year. So fair rent is for the whole year, whereas the actual rent is for the period for which it is actually let out. Deduction for interest on loan and municipal taxes shall not be restricted to the let out period, and the amount for the whole year shall be considered. Another situation, you have a house property, one portion is let out and another portion is self-occupied. If that be the case, the income from the portion or part of the property which is let out shall be computed separately under the head let out property, and the other portion or part which is self-occupied shall be computed under the self-occupied property category. So you have to apply the relevant rules. So for the portion which is let out, you apply the let out property. For the portion which is self-occupied, we apply the self-occupied property rules. So how are we going to deal with the municipal valuation and fair rent and standard rent? If they are not given separately, then we need to apportion them between the let out property, let out portion and the self-occupied portion, either on a plinth area basis or a built-up floor space or any other reasonable space. Similar treatment shall be given in respect of property taxes paid. We need to bifurcate, we need to apportion it.